Good morning, everyone. Welcome back to another lecture. So today is going to be a good opportunity to go through some of the stuff we've done over the past 9 lectures. It's a good opportunity because I covered a lot of stuff, and I know for those of you who are new to the profile, a lot of this is going to be pretty difficult to digest. And I appreciate that because, again, I'm aware that not everyone comes to this with the level of experience that I've had, or maybe even some other people have had, right? So this is your first foray with markets, then be patient with it, because I'm fully aware. Every ad, everything you've ever seen is based on candlesticks. In fact, I'm pretty sure that for 99.999% of you came to trading from looking at candlesticks that you saw on some social media operators' page. So I'm not under any delusion that ultimately all of this is going to be pretty new. So it's perfectly fine, just be patient with it. First and foremost. Secondly, if it's the first time you've come to the channel, welcome aboard. I'm hoping to make this a rewarding learning experience. Right? You're going to learn something that's going to probably change your life. I'm fairly certain it changed mine, so I probably know it's going to change yours. And if you haven't done any of the lectures before, I would suggest you start from the beginning. Don't jump in the middle. I say it all the time, if you do that, you're going to deny yourself a learning opportunity, right? It's an opportunity for you to learn something you didn't know before in full. So you've got no excuses at a later stage. If you're still doing the same things you were doing before, you're making the same bad trades, you can't build an edge. Essentially, what do I mean by an edge? You essentially can't build a strategy that has a 50-50 win to loss ratio, and you can make a 2-to-1 on the winning trades. And essentially, I always say a drawdown that is, well, it depends on the asset class, by the way. You know, if you're in a leverage market where, you know, it's one of these CFD Forex type markets, then if you're drawing down more than 15% over a given 20-day cycle, in my opinion, it's unsustainable. So you should be able, using market profile and everything I teach you, be able to build a 50-50 win-loss ratio at minimum, and you should also be able to achieve a 2-to-1 on all your trades. Because what I'm teaching you here is to trade from trade locations, which is part and parcel of being a market profile trader, is to understand trade location, is to be able to attack a trade from a trade location that is constant, it's always the same, and you're always looking at the same idea and process. So you build consistency. I'm pretty sure, like everyone else, that's what you want. You want consistency. Now, I've been running this channel for a good portion of 11 or 12 years, right? It's pretty old, 11 years. It's a pretty old channel. And I've been producing trading content on this channel for 11 years, right? And I've been trading for a lot longer. I'm a full-time trader. I trade for a living. I don't do anything else. I don't have a job. I don't have anything else. This is what I do and what I've done for a very long time. I did it professionally, and I'm also doing it now on a retail level. So I'm not like one of those popular YouTubers who essentially makes money from their YouTube alone and that's it, or essentially make money from some other source, like maybe selling courses. I do have things that are available to sell. That's not what I'm saying. I'm not saying that I don't sell anything. That would be ludicrous. Otherwise, what's the point of giving you all this good stuff if I don't get a benefit from it, right? So I'm not that pretentious, right? I'm not a liar. So the ultimate goal, the end goal is to build a business, right? I'm all about diversifying. I trade full time for a living, but I like to own a business around it. And since I can't do anything else, trading is a great way to do a business. Outside of other stuff like real estate and all that other good stuff, trading for me is a business, right? And all facets of it come into play. So it doesn't mean, because every now and again, I'll say to you, for example, if you want a TPO market profile, I have one available. You can purchase it from me. It's a lifetime license. It is essentially I mean, it's what you're looking at, right? You can't get better than this. I have it for MetaTrader 4, not available for MetaTrader 5, just because it couldn't be done for that platform the way it's designed. It's not available. MetaTrader 4 is the best option. It's going to be supported for a very long time by MetaQuotes. It's not going anywhere. Brokers have it, you can use it, and the price feeds are all free. So you don't have to spend any more money to get pricing. The alternatives are platforms like Sierra Charts or some other platforms where you're going to be paying crazy amounts of money every month just to run the platform and get access to the TPO. In some cases, you're going to pay for the TPO separately. And the day you don't want to pay those monthly subscriptions, you don't have access to it. What I offer is a lifetime license. You get it for good. It doesn't matter if you get a new account, you can easily just DM me and I can get that account reactivated, but I allow for it to be available on free MT4s. As long as I have those MT4 numbers, I can activate it. And I did have a question from one of the commenters on the YouTube channel with regards to how to set it up. And I'm going to actually use this opportunity as well to show you how to set up a TPO chart. So just to backtrack, right? That's what I mean. I've got stuff available. It's part of the business. I do have, again, if you wanted access to the basics on market profile, these are lecture series, right? So I don't have to start from the beginning, even though I did. If you go from the beginning of this lecture, you're going to learn a lot about the profile. But I have a free course on market profile, and I have one that is on Udemy. It's paid, but it's really cheap. So I do try and monetize things. I'm not saying that I don't, right? But I'm just saying that there are a lot of people teaching you where that's their primary source. That is their business. Their business is to teach you stuff. And that's what they do. And I'm not crying that down because it's a business model and that's how they make money, but they don't have skin in the game. They just don't have skin in the game. And that's the difference, right? I have skin in the game. So a lot of the stuff I talk about, I actually show you that I actually did some of these trades. I can't do every trade naturally because I'm showing you examples on the NASDAQ because I know some of you trade the NASDAQ. I'm showing you examples on gold. Some of you trade gold. I'm showing you example on cable, which is my favorite. I trade cable. I'm a cable trader. Predominantly, that's how I do my day-to-day business. But I also have commodity funds, so I do look at other things, right? For example, you see me talking about corn. I trade agris, right? I show you stuff on crude oil, but I'm not in every trade all the time. I sell option premium, but I strategically do these things depending on the market cycles, depending on other factors. You will see me occasionally doing different types of trades and often sometimes sharing them on Discord. All due respect, I don't share everything on the Discord. I do share wins, I do share losses. I'm not just purely win all the time type trader, and I tell you this through the lecture series that that's not going to happen. Right? You're going to lose trades. I'm not that, but at the same time, I'm not going to show you everything. Right? That's not going to happen either, because I've got people who come to me for private mentorship where I show them a lot and I talk to them about stuff that I won't talk to you about on the lecture series. Right? If you want that access to me in that way, then you have to make that decision to get in touch with me and say, this is what I want from you, because from what I see you doing, I think that this is going to be beneficial to me in the long term, and I need someone to mentor me I can talk to consistently. A lot of the guys I've mentored, they message me all the time. They're in the Discord server, they don't talk a lot, but they message me all the time. If they have things that they're doing, they're showing me screenshots, I'm getting back to them, I'm trying to give them pointers. I will even arrange sit downs with them at different points in time, right? So that I can give them the kind of perspective that I got and I know they're going to need. But that's a decision they made, and they come to me and they're getting the benefit of that, making that decision. But if you don't want to make that decision, I've got the lecture series, I've got free stuff that you can digest, and if you can make it work off the back of that, fantastic. But if you need access to me in a way where maybe it's more than that, it's mentorship you need, maybe it's psychological, and all of these are hurdles I've managed to get, and I hope I'm bringing some of this across when I'm doing the lecture series as well. Because emotional stability is part and parcel of being a trader. If you're emotionally unstable, this is a problem. And building that emotional stability sometimes it can sound easier than it is, right? It can be very difficult to do that. So there's certain concepts that I can help bury in your mindset that will allow you to get over that emotional instability. But again, building strategies, having that access, making sure you're following stuff and going with your own script, for lack of a better word, that's a mentorship thing. That's the kind of stuff you've got to talk to me about. That's the kind of stuff that I can't give away for free, as much as I'd love to. But that's every individual trader's decision depending on their journey, right? So, but I have skin in the game. That's the point. I do this for a living. Anyway, because I can assure you, I won't survive if I was just relying on the YouTube channel. I've got less than 5,000 subscribers on this channel, despite being around for 11 years and providing incredible value, as you can see from the channel. But the way YouTube is designed, it's not designed to promote traders like me. It's designed to promote traders who are not traders, who are marketers, and they're very good at it and they understand the YouTube algorithm very well, and they can essentially grow an audience really fast using multiple networks and ways of doing things. That's a job in itself. Unfortunately, I don't have the time to do it, and as a result, my channel's smaller, but my small channel certainly does deliver a lot of value, which is why I built the channel. So I don't care if it has 10,000 subscribers, 100 or 5, as long as the people who watch this channel are feeling they get a benefit and they support the channel, I'm happy with that. So I guess that's a message to say, support the channel, like, subscribe. All right, I've jabbled on for too long. Now it's time to get into the meat of things. So we're going to jump into some process to cover what we looked at in the past, and then we're going to move forward and talk about some more stuff. So this is our weekly profile of cable. So if you go back to the last 2 lectures, right, so you watch those last 2 lectures, I would say go back to the beginning if you're new, but if you've been following the series and you have done what I told you to do, watch every single lecture from lesson 1 to where we are right now. If you've done that, you would be in sync. If you haven't done that, then go and do that. If you've done it, then go back and watch the last 2 lectures to rejog your memory. And I would implore you to watch these lectures over and over again, right? I don't think this is something that it will just be a one-time thing, but to jog your memory, go back and review those lectures. What you're looking for is for what I said. I said that typically this is a weekly profile. So we've been going up, up, up. And then what did we experience here? Right, as we cross this level, I'm going to delete all of this stuff so we can start over again. And I'm going today I'm going to show you the trades that I did using exactly what we spoke about. Right, so the first thing I said to you guys is that we moved from the lows, right, and we broke the liquidity. Right, so essentially we broke through into liquidity. And what does that do? It essentially brings in hidden orders, which are essentially buy stops, sell stops, stop losses, all stop orders. Stop orders are not available in any kind of limit order book. In a CFD environment, they'll work exactly the same. It's an instruction to your broker to take you out of a position. So there's no, even on a central exchange, you can't see stop orders. Right? The only person who knows where those stop orders is your broker. And your broker can sell that information to someone else, and I can guarantee you they do. They can tell someone else and say, I've got a ton of stops at this level, so if you wanted to buy or sell something, that would be the level to do it. So if you're long the market and you want to get out, you're going to have to sell to someone, so someone's going to have to buy from you. And the best place to do that is when there's a high amount of liquidity, and that's where buy stops are going to get activated. So the market drove up, and we activated the buy stops, right? Because the buy stops are going to rest above significant highs. So whether this is going to be a high of week, in this case, or the weekly profile, or it's a high of day, or it's a high of session, or it could be where we had a pullback. If the market was going up, we got a pullback, and then those sell orders that you were seeing that were pushing the market down, that could be some degree of manipulation, right? It could be an algorithm that is bidding prices lower. But because those prices have to print, it doesn't matter if one contract, two contracts, half a contract, whatever is being filled at those levels. It doesn't matter. The fact is the market's been bid lower and we're getting price prints that are taking it down. So an algorithm is pricing that market lower. And as soon as it doesn't want to do that anymore, it will stop and then start to price it higher. So if we're dropping on a market, we're dipping and then we start to go higher, traditionally, anyone who's long that market is going to put a stop below the low of the last down print candle, right? So let's put this into words. Split this. So for example, the market was going up in A, B, C, and D periods, which were 4-hour rotations. And then it starts to pull back in E, F, G, where people are going to put stops. As soon as we go H and I, anyone long in I is going to put stops below F and G. And then in J period, we come down, we draw on those stops because those will be sell stops or sell stop losses. Right, and they're going to be positioned there because people are thinking if the market hits that level, I should want to get out of the trade because then it's probably going to go in the opposite direction. But that's not the case. When we draw down here and we hit those sell stops, we're going to trigger and bring them back in. But when we sell, we're selling to people who want to buy. And for the people who want to buy, they're expecting the market to go up. And if they're the kind of people that have been sold your orders to, then they're going to rally the market higher. But we need that confirmation, which is what we get in K period, right? Where we rally and then close up. So now you can say, well, it's a safe idea to take a long because I've seen a run on the sell stops. And that means a large entity probably required them. So now they've got their sell stops, they've got their position. It shouldn't go back down again unless they need more. In which case, they're going to go after your stop and my stop that will now be sitting under the K period low. Sadly, there's nothing you can do about that. If they do decide to make a run on those stops, then the market will fail again and they'll run the stops in J and K and then the market will continue higher. There is no rhyme or reason to this stuff. It's just orders. Like people need them, market's got to go after them. That's what I mean by people will put stops in places that are obvious because that's what everyone teaches. Right? Open any book, open anything you want to open. That's what gets taught. Right? Everyone tells you the same thing. It's not any different. Right? Put the stops under the lows. Put the stops at the highs. I'm going to put a stop at a higher day. That's what everyone talks about. And that's what you're going to say. So even on a weekly chart, sadly, people are going to put stops there because, again, if I'm saying sadly, but where else are you going to put the stops? There's nowhere else to put them. So that's what we're seeing here, people, is we get a trend week, we move up, close at a high, and to you, it thinks we're getting, you see it like we're getting a higher close. What I see is gap down. Sell stops are going to get activated above these levels. That's what I'm seeing. So buy stops are going to get activated above these levels. That's what I'm seeing. I'm not seeing anything else. I'm not seeing a higher close. I know there's a higher close, but that's not what I'm looking for. I'm looking to see, is this market going to sell back? And when it sells back, where's it going to go? That's my mindset. So step one in this process is we got to know where we are. Are we running into buy stops? Are we running into sell stops? Right? And that's liquidity. Right? So the first part of any process is understanding where liquidity is. So as a trader, you need to be able to map that out really quickly. With market profile, you can do that a lot easier. You can map out essentially where you see liquidity really fast, and there are other things you can tell and see because those are also going to add to your decision making, and I'm going to show you how. So that's the first thing we want to be able to decipher is liquidity. Where are those hidden orders going to rest? Point in case. So this is what we saw here. We saw a draw initially into liquidity. So coming into the next week, because we got a solid close for the week, coming into next week, I'm thinking Well, we've got a high of week. Anyone short is going to put what above the D period? They're going to put buy stops. And then they're going to go short. And where they're going to go short till, most likely. Now, if you look at this profile, you can see what we call stacks, right? These bulges. And these bulges occur because the market spent a lot of time trading at those prices. And what that has done is caused a build up in volume. So that's a volume at price model. So it's how much volume is trading at each price level. That's what this is telling you. So if I can see this, then I also know that's potentially where the market's going to stop. Now, there are a lot of traders teaching volume profile, right? Where they're looking at a histogram of volume, right? A cumulative volume. So they're looking at a histogram of cumulative volume over a series of these individual time price opportunity profiles, right? So each individual profile, all of their volume at price, cumulative. There's a problem with that. It's not segmented enough. Whilst it's good enough for you to be able to see where historically there's been cumulative volume, but it doesn't give you a complete picture. Now you can take the profile and merge it, right? I have a merge function here where you can create those cumulative profiles by merging the profile and then trade an individual profile off the cumulative. What do I mean by that? I'm going to show you. So if I merge left, merge left, merge left, I've got a cumulative profile and I can trade this profile against these. But I don't like doing that. I know the disadvantages to doing that, right? Because I've done it and I know that it doesn't work to perfection, right? I don't get the information I want to get and I miss a lot of nuance. I prefer to split up the profile so I can see each individual profile week to week very clearly. So I can essentially see a weekly chart and then trade a 4-hour time frame within that weekly chart. And that's what I do when I trade the rotations. So hopefully it should start to make a little bit more sense. That, hang on a second, there is a way for me to have a weekly chart and then trade inside of the weekly chart? Yeah, exactly. There is a way. Just don't use candlesticks. Use market profile instead. Right, so it can be done. We call it segmentation, right? So we segment the market a little bit so we can have a big window and then trade a smaller window within that. So we don't get phased out. There's no emotion in these charts. You don't get phased out by all the chaos and all the green and red and all the other stuff in candlesticks. So candlesticks have their uses. If I wanted to have like a 300 or 400 day look back, I won't use a profile for that. I'll just look at the candlesticks and get that level 1 information. And then that's great. I can just easily translate that into a profile for more recent information, right? More recent information is always relevant, right? There's only a point where you're going to do a look back till, and then you're trading a macro. So where are we going to go back to? We're going to go back to likely where this volume is, right? And that's a bid stack, and that's where we're going to rebound from, or we're going to find support. And if we go through it, then we just seek the next area, right? And that's essentially the second part of our process is, where's the volume? You can do it this way. If you're using a candlestick, you can use tick volume level 1. You go to my Udemy page, I've got like a ton of information on that, even on this YouTube channel around volume, and it's completely free. For that, you'd have to do my PTP Professional Trader Program, where I do cover candlesticks quite a bit, in addition to covering aspects of market profile. But if you're purely interested in just learning from market profile, then just continue the lecture series. At some point, we're going to talk about tick volume anyway. But there is tick volume, right? So worst comes to worst, you can go back to candlesticks and look at the tick volume there and build your analysis on a candlestick chart if you want, right? Personally, there's no point regressing if you're already at the stage where most professionals are, 10 years into their journey as professional traders. It won't make sense. So volume is the second part of our process. And the next part and the final part is time, right? So when are we taking the trade? Is it in a US NASDAQ session, Chicago? Is it in a London or European London session? Is it in an Asian session, New Zealand, Australia, or Tokyo, right? So time is important when we take the trades. Is it the beginning of the week, in the opening range at that point, or when are we taking the trade? We need to know that. And that's the last part of our process is what's the time? When is the best time to trade? All right, so hopefully we understand the process. So if we go back and we just take a step back to what I was saying is that at the close of this week, we go up. And what are we going to find above the highs of the period? Buy stops. And we should draw on those buy stops. Now, if I split this rotation for a second, and I pull this over, right, this is what that should look like to you. So we open the week, A period, first rotation, first 4 hours, and then we go B period, C period, and then we start to struggle. We initially get a move up, a flush, weakness. We consolidate, a move up, a flush, weakness. What's that telling you? Every time we try and go up, we get hit back down again. So clearly, we're running the buy stops. So we go up, hit a cluster of buy stops, people sell into those buy stops, it comes down. We consolidate, we run up, hit a cluster of buy stops, it comes down. And in I period, we break lower, right? Immediately we cut, break the lows of H, D, E. So we hit all this consolidation. We do an attempted rally in J period and we break it down in K. What is different in K period in the week than in all these other periods? It's the price action. The pressure on the market is so strong in K period. That's a clear indication that the market is now taking all the buy stops it can take. So all the sellers who needed to sell at this position have now overwhelmed the market and they're now driving it lower. K period was the clear example. With experience, you might have said in I period of the week, that was the best time to run. And if you look at a 4 hour window, it's a 2 a.m. London window to 6 a.m. London window. So this will be the start of that 2 a.m. window, right? So, and then it does 4 hours and then into the next 4 hour rotation. So 2 a.m., that's an Asia session. So it's not going to attract a lot of volume in the same way. But for an Asia session, look at the move. So over those 4 hours of Asia, we were consistently pressing lower. And then you can see in the London session, so the 6 a.m. to 10 window, right? It says 8 on here, but it's because it's a 2 hour shift on this broker. But it's actually 6 a.m. in London. So you can see 6 a.m. in London, you can see the rally in J period. It's very clear to see. So the London traders were happy to take the lows in Asia and run it back to the highs of Asia, and then look what happens in the American session, which will be the 10 a.m. to 4 p.m. window in London. It was very decisive. So time is an important part of the equation. So talking about that time, right? So we got liquidity, volume, time. It's my trifecta, that's what I call it. So the trifecta you can see is all in place. We've run the stops, we can see where the volume is, and now we're getting a response from a major session, which is the US session. Not complicated. From that point, I'm thinking I want to be a seller. I've got two choices. On the close, I can wait for a slight bid up in price and then go short, round about the end period highs, right? And then I can have my stop above the highs here, or I could go for the ultimate high depending on what I'm trying to capture. Because I know that I'm going for the bid stack, then I'm probably not going to have stops too high because I want to be able to capture that good risk reward profiling. And to be honest, if this is what I expect it to be, then we shouldn't really be trading the high. So we shouldn't be taking any, we shouldn't do any run on stops above the US session high, right? So we shouldn't go for buy stops above the session highs. Shouldn't happen. If that happened, then that's a problem, right? It just means that there's going to be more aggressive selling will follow, or essentially we're going to end up closing above the K period high, and that means upward continuation. What it means is essentially we're going for stops that are higher. The stops here are just not sufficient for what the larger entities want, and the algorithms are willing to essentially offer them higher prices, right? And as a consequence, they're going to go up there to essentially sell at those higher prices. Nothing we can do about that, but that's not what happened in this scenario. What happened last week was we broke down, and then we understand we're going to try and make for the volume, right? So we're going to go for the bid stack where they're likely to be passive real orders. Why are there likely to be passive real orders there? Right, so why are there likely to be real limit orders sitting? And that's what I'm saying, limit orders, right? Passive real orders. Why are they going to be there? Is because one, we've actually seen in the past that traders did actually buy this level. That's why we've got the volume build up and the break up and close. So traders bought it because price is higher and we can see the volume. So we know that if there's any safe place to put a limit order, it will have to be here. If you wanted to protect your position equally, you're going to have more orders here. So this is the most legit place I can think of that that traders are going to aim for, right? Because we should see some buying here, right? And if we mark out that level, right, top to bottom, you can actually see that's where we drew in buy, not complicated. So we want to be short into that bid stack. That's where we think the market's going to stop. I don't care if you believe that you can get 6 to 1 or 7 to 1 on that trade. Or if you break even a trade and just trail it, it's going to be better for you. No. Yeah, hit that volume level, you get the hell out. The only way you want to be back in is if we go through it and then we start to rally back up and take out some more liquidity. But other than that, that's where you're aiming for. And that's your week's run. Now, if you calculate what that run would have been from let's say about here, that was a 102 pip run to the absolute bottom, right? If we're talking about just hitting the fair price, which will be good enough for you as a trader, that's about a 92 tick run. The risk on that trade was about 46 pips to the high of K period, 46, 45, whatever. This is a 5 pip filter on each letter, right? So it's a good filter. So you're not worried about the tail action, right? Am I stop going to get hit? Is it going to come close? It's a solid place to sit. And then we're going down. Now tell me who would want 90 pips between a Wednesday and a Friday. It might not seem like a lot for a week's run. But there are various ways you can add into this position on the way down as long as you know where it's going and where your ultimate stop needs to be and how you can manage those trades, right? And we're going to talk about that in later lectures. So we're going to talk about how we risk manage and money manage in different ways, right? So we can stay profitable. So this is what that whole price action looked like when we condensed the profile. So what have we seen? We've seen a draw on stops above the highs of the week. And then we've come down and traded the volume and then we're going back up again. Now, if we are thinking we're going to go back up from here, where's the next place we're going to go? Well, we delete this. We're going to go for the stops at a high of week. Again, we're down here, but if we're delivering price, then we're looking to target the buy stops above the higher week. It will make for new highs. The pound will still be technically appreciating, but look where we are. So the next thing is that if we draw buy stops from here and come back down again, which is likely, then we are setting up the stage potentially to finish off the stop run above the high here, the higher week, and then we're going to break back in. So what do you think starts to happen as soon as price starts to enter this price area? Well, the volume's going to give up for sure, and then we're probably going to start to deliver price against the week. And where do you think we're likely to keep delivering those prices to? Well, that will put us down here. That's where we're going to find the next weekly based sell stop run. And that means prices are going to just deliver all the way down in a very systematic way where we're going to be consistently taking that liquidity, those hidden stop orders. They're largely going to be buy stops. Then we're going to take more buy stops on the way down than we take sell stops. Well, that's just common sense. If the market's going to force its way down, it needs to take more buy stops to do that. And when it reaches a terminus point, it will start to take sell stops and make its way back up. The sooner traders understand that this is market microstructure, right? This is a academic thesis around markets, how the dealer manages inventory and how markets are made. As soon as people start to understand that this is how markets function, You got a pricing algorithm that makes a market, and we've got orders that are placed by retail traders. And I call everyone retail traders because you've got makers and takers. Makers are smaller amount, large entities that make markets, high frequency traded and so on. And then we've got takers, retail traders, institutions that are big retail traders, and they're now moving into the territory of makers. And in between them, we got brokers or intermediaries that, in my opinion, they just collude to benefit makers. So makers are in small amounts and takers are in large amounts. And takers place trades randomly, right? And I explained this at the beginning of the lecture. So if you go back to the previous lecture, I explained how a market functions. And I gave an example. There's got to be a YouTube channel floating somewhere, and because I know it exists because I've seen it, and the quant was explaining how to make a market. If you wanted to replicate the financial markets in, like, I don't know, let's say a developing country, try not to insult anyone's country, but I'm trying to find an example of a developing country that doesn't have a tradable market. And nothing's coming to mind, but I'm pretty sure there is some country that doesn't have a tradable market, and you wanted to give them a tradable market. Well, someone can actually just program an algorithm to do that. So if you're a maker and you wanted to create a market, what you do is you create an algorithm that will essentially offer prices to takers, and takers will take those prices. But there has to be a hell of a lot of takers, and they all have to be willing to place their trades randomly for the market to work. So a maker can create that, and that quant created a market right in front of my eyes. Right, a market has candlesticks, and the programming works where the takers are random. They're kind of simulated takers, but they essentially simulates human behavior, and they're placing all these orders. And the makers, they're just a small amount of makers, and they're assuming that the makers are willing to take every price, right? So they're willing to use their algorithms to go and search for orders to sell, buy. And what was happening was technically what we see in every other market. Right, absolutely insane. It was, you know what? If I can find that video, I will link it to one of these lectures at some point, and I'll tell you guys that I've done it at the bottom of the description when I find it. But I'm gonna have to look because I watched it some time ago. It's not like I didn't already understand that this is kind of, but it was really interesting to see it from the perspective of a quant who's actually built these kind of algorithms for makers. Anyway, moving on. And I just want people to understand that it's not my BS, right? This is reality. This is how markets are created. There's a small amount of people who have access to making a market, who can do the kind of volume that you need to do to make a market. And there's a vast number of people with tiny amounts of capital who don't know what the hell they're doing for the most part and are willing to make trades. So all we're trying to do as slightly more informed traders is to be able to exploit that market, the behavior of that market. Okay, so back to where we were. So coming into this new week, I know where the liquidity is. So let's split the profile. So what happens? We open, we go through value, we do a value trade initially, pull back, set a low. This is more a low in the short term. We set a low, and then we go up, and then we start to attack initially some of the buy stops up here. But that's not good enough, right? So we consolidate a little bit, and then we start breaking the highs, and then we go after the buy stops here. So if we're trading up here, I might as well wait to get the stops triggered above here. And once that happens, in my mind, I think, well, we're going to start to deliver first to this level, but realistically, we're going to deliver to that level. Right? That's going to be the first stop. And what can we see at this level? Well, it's a level that's been traded before, and we can see volume. Right? So we know that coming into this level, there's going to be a reaction to go higher. Now, if this reaction holds, so let's say the C period that's trading right now, which is the window we're in, that's 10 a.m. window. The 10 a.m. window to the 10, 11, 12, to the 2 p.m. window. My bad. I need to do a bit of a recount there. Maths in my head. 10 a.m. window to the 2 p.m. window. So that's still technically European session, right? So we're just about now breaking in to that US session start, right? Which will kick in the next 6 minutes, and that will put us in D period, right? And if that's the case, then all we need to do is take out the low of C period, and then it's done. All of this is probably going to start to collapse, and then we're going to deliver down to the lows of J and most likely the low of week, right? Where in effect, we might attract some liquidity to go back higher. But from where we're standing, this, if we close up this profile and it stays this way and we open and take the low, then we're exactly close to that place where we're going to start to get a much bigger drop now and start to deliver against the week. And then we have to change our dynamic, right? We start to now look for short-term highs to be set and liquidity triggered above those short-term highs, right? So it changes the game a little bit. And that's what's happened for cable. So if we double back to a daily profile, we can see that picture a little bit more clearer. So what do we see here? We see a draw, and this is gonna now start to make a lot more sense. So we see the high, which is the F period high, right? And then we see in a major, so this is 2 p.m., 1 hour rotations, daily profile, 2 p.m. What happens at 2 p.m.? The NASDAQ. So 2 p.m., 2:30 NASDAQ open, 3 p.m., and that's the 1 hour frame, right? 2 to 3. So half an hour into this frame, the NASDAQ is going to open, or half an hour into that rotation, the NASDAQ is going to open. And then NASDAQ opens, we're going to start to see a run on buy stops in the NASDAQ. So as soon as we break down, then we have to make the assumption that we're seeing a run on buy stops. And it's a good opportunity to be short with stops above the high of the NASDAQ. And that's why time is important, guys. And then where are we going to deliver to? So we close this profile. Well, we got a stack here, right? So that, and if we split, we want to know what's going on inside of that profile, then we can see, well, there are going to be sell stops down here and sell stops down here. But for me, because we got some volume here, that's why I look to get out of the trade. And what am I looking to see? I want to see that we draw on this stop level. We have a bit of a draw here, but for me, I don't like the look of that. I want to be able to see if we can do a draw on the I period low, right? And this will be essentially a 6 a.m. to 7 a.m. window, right? So that would have been the Asia low from 2 days ago. That's why I'm looking, and if we can get that low, we can probably draw on this low. But it's early days at the moment on a Friday, so the market hasn't really run its course yet, but this is probably the last liquid session. So if we're not down there by our S&T period, then we can start to make the educated assumption that come the Asia open, we're either going to take out the NASDAQ low or we're going to move higher. But we can make that assessment after our period, which will be the Chicago session, where all the big futures traders are likely to take their positions. So time is that relevant thing. And what have we also done that's noticeable? We've driven through the bid stack that should have held this market. We've gone right through it, which means that we're going to draw liquidity under a bid stack. And what lies under limit orders? It's normally stop orders. Why do I say that? If you put a buy limit to go higher, you're going to put a sell stop below that. Because a buy limit will get you into a buy position, a sell stop will act as a stop loss to take you out of that buy position. So if you set a limit order back in here to rescue this market, then your stops are going to go at a low of I, or you're going to go just below the volume. And that's why we've got a draw here. Is this going to hold up? I don't know, because the session isn't even over yet, and I need to see how the Chicago traders respond and what kind of volume they respond with. I want to be able to see that too. Right, so I'll take a breath, right? So we're not going to continue along this vein anymore. What I'm going to do now is I'm going to show you exactly what those trades look like for me. So here's my trade deal map, right? And for the first time, I'm going to show you guys, just for this occasion, what I was playing with across the week. So you can see there 1, 2, 3, 4, 5 trades done. 6 in total, but 5 trades that are linked to, that technically I consider to be individual trades, because the 2 down here were part of an accumulated position that I was willing to take. And what can we see? In each of these examples, there's something that happened that made me want to be in these positions. So let's look at the days. So this was on the 6th of February. So I'm going to pop back up and we're going to have a look at each one of these, and you're going to see why I took these trades. So, the 2nd of June. Did I say February? The 2nd of June. My apologies, just dates a bit reversed. So the 2nd of June. I've started to read dates like Americans. My bad. So 2nd of June, right? That was this profile here. If I split this profile, I can explain to you why I took this trade. So let's split this one too, and then we split this one here. Right, I'm going to split all of them. First and foremost, again, looking at my time equation, this was the Q period and the NASDAQ. So after a while, you get used to calling them Q period, you get used to calling them R period, and you know exactly what Q is and what R is, right? So this was the NASDAQ open, and what did we see when we ran down in the NASDAQ? Most people saw the NASDAQ taking off and they're like, great, we're about to go short, right? Because they can see the sell stops or the buy stops get run in the London, above the London liquidity, right? So we can see that, and then we pushed into the NASDAQ. But here's the trick, right? And this alone is gonna make you money, right? This is gonna be a gift to you, what I'm about to say to you. There's a trick. Always wait for the NASDAQ in Chicago to play out. This is a little nuance, that's all I'm gonna say. Unless you're deathly sure that this move is going to be led by the stock market, at least give it to see what the NASDAQ does against that before you make a decision, right? So people got trapped initially because we got this short run over a short-term high, push lower, and then run into a slightly more long-term low, which was down here. Now, what's underneath here? Those were the London lows, right? So there would have been sell stops under here. And also, it's the lows going back to New York on the prior day. So they're also going to be stops here. And then we've got stops that are going to sit under the L period low. And then we've got this strong 7 a.m. run in London, or just pre-London. So this draw here was significant, and then Chicago closed up into the NASDAQ. So you've got 2 choices at this point. You can think to yourself that we're going to get short, but if you look at where this market was delivering from, it was actually delivering from a high. So there's a lot of buy stops up here. So rather than be short in a hole, so essentially be short too low, start to think of it more like what's the best trade location to maximize, and that's the Chicago pullback is what I want to trade with. So then I'm going to go long as soon as we dip back in so I can get a good price, right? But initially, I'm going to try and get myself filled as soon as possible just in case. So I'm going to split the position I want to take in a 2. And then I'm going to have my stops under the R period low, because that's the Chicago low, this should hold. And then if we dip any lower, I'll do an average in. Right? And then what am I looking to do? I'm looking to take this over the D period high, right, which will be up here. I know there'll be some liquidity here, but if this is going to be, let me close this. What else do we see when I collapse these profiles? Right, I should delete these for a second. What should be apparent to you is that we can see that there was volume, a hell of a lot of it, trading here. So the moment that we started to close above this level, which was D period, then we can start to anticipate a trade for the fair price, which is what I would have been aiming for. Let me see if I can hit the fair price, and that will be a good trade. Well, we achieved that by the London Open. I don't have any reason to keep staying in this position. London opens, I'm getting out of that trade immediately on the London Open. Why would traders exit on the London Open? Because it brings in a hell of a lot of liquidity. That's it. London's open, boom, boom, everyone's trading, hell of a lot of liquidity. And that's where I want to be, right? And that's my exit. point in case. That's the trade that you're looking at here, right? And now what did I do for these trades? Well, that's my deal map. This was a 2-lot position. This was another 2-lot position. So that's a 4-lot position that I built into with stops at the low. Really good risk reward for me, and it felt perfect trade. And where did I get out? It's exactly the fair price. You can even see the consolidation there. Same thing. And when using the profile, I don't have to worry about tail actions, right? Because the profile's giving me all the information I need to know, and it's filtered. This was my next trade, right? We can explore that, right? So that brings us here, right? So that was the next one. Split the rotation, and I'm going to split this, right? So let's just piggyback, make sure we're on the right date. So that trade went across 2 days. This was the 3rd of June, and this was the 4th of June. Let's have a look at those same trades. 3rd of June, 4th of June. So again, NASDAQ open, so we see initially 1 o'clock New York. What's below the lows? Liquidity, buy stops. Sell stops, sorry, my bad. Liquidity, sell stops. I always do that. I always somehow say buy stop for sell stop. I could never get that stuff right. So that's the first thing, there's liquidity down here. Secondly, there's liquidity on the day underneath the lows of the London lows. You can see that dink here and that rally. So there's some liquidity here. More short-term liquidity, but liquidity there. And this was London prior, where we had that really big move, and there's going to be some liquidity at the lows there, right? So let's move this up a little bit. So what we have is a lot of stops at different points where people are going to put those stops. So what do you notice I'm doing? I'm being super creative about what I'm thinking about other traders putting their liquidity. Right? I'm not thinking about myself. I'm thinking, where the hell are those other traders going to put their liquidity? And that's what I'm trying to target. And I can see the London low, there will be liquidity there from some of the stronger London traders. And what's below them? It's a bid stack, so there's a lot of volume. So this has to be support. So it's trading so close to a support level, right? I'm going to mark this out again. It's also a good proposition for anyone trying to get long. And what do we get in our period? So we initially go do the liquidity, finish up at the NASDAQ, and then we trade up. So immediately, look where we close on. This is a long. So as soon as we can dip back into Chicago, I want to get long, right? And where am I looking to take this? Well, I'm just trying to get this, if possible, to value high. Why value high? Well, first and foremost, I can see there's an offer stack here. 2, there's liquidity above the highs, but I can't guarantee I'm going to get that. What if this market is just trying to set me up because now I'm buying a consolidation to go higher? So I'm going to be cautious. It's like, well, I'm going to get out as soon as I see weakness. And this is what happened here. So we ran this into Chicago the next day, and now I'm looking to exit that trade. And that's what you see here, is me exiting as soon as we start to show weakness in that Chicago session. I didn't trust it anymore. And what did I do after that? I went short, but I was punished. So this was a losing trade. But look at my position sizes now. So this was another 2-lot position to go long. This here was a 150k position to go short. Why do you think I did that? It's because I wasn't confident on the short side. Why wasn't I confident on the short side? Well, like I said to you, I was worried that the sellers here are going to be able to regain control. And we got 2 value highs staring me in the face. And then we got liquidity here. So we could go and chase after that liquidity, but I don't want to be the last one trying to get the cream on the top. So I did that, and I went short. And I was right for about a couple of hours, and then I wasn't right anymore. And that's okay, because one, I have a smaller size on. 2, I'm well aware of what I think the potential of that trade was. And I know it doesn't matter if I'm wrong, I'm going to get another opportunity to get even a better trade, which is what follows next. Is, again, we open the NASDAQ, we draw on that liquidity, and I can see the volume and the weakness. That's what you're seeing here on the tick volume. And then we come down and we close in Chicago. That's the cue for me to get short on Chicago. And that's what I did here. So the moment we went in, we drew that liquidity. What am I coming in with? 2 lots. I'm more confident in this move. And then I'm going to take this down. Where am I looking to get out of that trade? Well, I want to just get out of the bid stack, right? So I want us to drive in and then trigger me out where the volume hits this level, because again, I'm expecting a reaction at that price. So now we've hit that level, right? We've drawn on liquidity at the lows. What I'm looking for is for Chicago to close above the Q period high. If I'm going to long this, that's what I want to see, because I know that at this point in time, I'm hitting a lot of support at the bid stack. So I want to see how the Chicago session finishes, and then I'll make the decision whether I want to go long. And I'll be looking for the trail bid, and then I'll put in a long, and then I'll fire it. In this case, what am I looking for? I'm looking for the market to either set up, right? And that's if my longer term thesis is correct. I'm looking for the market to set up a short term high, which could be drawing on buy stops at the high. So I want to make sure that we clear the high and we settle. And at that point, I'll make the decision to get long. Now, I'm not very confident in this long, so I'm going to take a smaller position if we settle up, which I don't know yet. If we lose the Q period low, then it's all over. Then my longer term thesis now comes into play, which is we're going to start seeing short term highs set up and a run on buy stops. This should make sense to everyone, right? And that has been my trading on cable, right? Those are my positions, and you can see that here. So just to show you that exactly what I'm teaching you here is what I'm doing, and this is how it works. As you can see, I don't win all my trades. It's about good money management, making good decisions. I'm not gonna be hitting every trade and hitting it out of the park, but I'm pretty sure I'm gonna get a lot of trades right if I'm working with the same fury all the time. Point in case, guys. Right, so we'll stop it here on this lecture. I appreciate all of you. If you haven't subscribed to the channel, you know what to do. I think this, I don't know if you're going to get value like this anywhere else. No one else is teaching market profile anyway. And the reality of it is that, let alone teaching it the way I'm teaching it, you're not going to find anyone teaching you this. Concepts around, I've seen it all over the internet. There are a lot of famous YouTuber type teachers as well who are teaching stuff around liquidity. They're teaching stuff around fairest prices, minus developments, or I hear now on the internet being called unopposed buying, selling, or being called fair value gaps, whatever it is, and it's great that there are people out there trying to educate everybody, and I think that's a really good thing that traders with more experience in the community are trying to pass that on. I can see also there's a battle between educators, like people are trying to teach people. There's a huge battle out there with people like, that guy's not doing the right thing. That is none. It's all bollocks. As long as you can build a strategy and a system. I prefer market profile to do this because of its simplicity, and its simplicity to visualize things. Not because it's some cult. It's some cult of personality. That's not what it is. It's just really a situation where it makes it a lot easier for traders. And I think as a new trader, the sooner you get to grips with some of these things, your trading journey is going to be smoother, it's going to be easier, and you're probably going to switch off social media, which I always advise. The reality is that you're not going to be listening to people telling you can't make 20% a month, or people who are telling you that, that will mean that you'll be a trillionaire by 2025. Because the reality of, I always say this, I'm going to say this one last time before closing off this session, is that volume, the amount you trade. First and foremost, traditional brokers, they'll only allow you to trade 100 lots. And that's it. You're not going to be able to get more than that volume-wise. And good luck trading 100 lots. You're going to get filled in little tiny chunks, right? Because it's a lot of lot size. And that's, I think, the largest size you can take. I'm saying 100 lots. It could be 10 lots, right? But no, I think 10 lots is a million notional. So I think it's 10 million notional is the largest they'll allow, right? Because these brokers that have to be your counterparty, they don't want the risk of more than 100 lots. Beyond that, go to a prime broker like a bank, Then you start talking about interactive brokers, other people who can carry you maybe 1,000 lots, right? Beyond that, you start having to work directly with these other kind of clearinghouse type parties, and then you have to start to report your positions. Your strategies are going to get limited. So the basic strategies that I'm showing you here, they're going to be a lot harder for you to execute now on a retail level if you're trading beyond a certain size, because now you have to start to act like a maker. You have to build systems. You have to build systems that effectively are going to act in the same way these predatory algorithms act. You're going to have to start looking for where orders are going to be. You're going to have to secretly execute orders. You're going to have to do all those different things. So hopefully this can make sense to everybody. Sorry, I had to pause because I had to grab a quick phone call, and I don't know if I lost my train of thought entirely. So for some reason this video, the whole thing just pauses and it just restarts and it looks like I'm on a tangent. That's what's happened. Anyway, I would like to see this thing close higher and hold solidly in our period, backed up as well, because I can see the NASDAQ volume is pretty high. Definitely not as high as yesterday, so I'm pretty sure that the sellers here are in control. I can see that from the tip volume quite easily. So as soon as we can get that run, I'm expecting this market would go up and set up a short-term high. Right, but you never know. It may well go and take a Q period liquidity up here. Longer term, I think the pound does have a lot of potential to deliver into the 140s. So again, I'm not saying that we can't do higher prices. What I'm saying is let the market tell you essentially what you need to do. All right, well, let's wrap this up now. Again, like I said, it's great having you guys. I know you know what to do in terms of subscribe. Till the next video, guys. Adios.